Huge news today, and it's not just about price. The Shanghai Gold Exchange is cutting margin ratios and lowering price limits for some gold and silver contracts, starting from the February 24th closing settlement. That is big. This is Ashley Queen. Let's talk gold and silver. Because when an exchange changes margin rules, it changes leverage. When it changes price limits, it changes how far markets can move in a day. Exchanges don't adjust these things for entertainment. They adjust them because volatility conditions demand flexibility. And this is happening while silver just dropped more than 2%, while tariffs are being challenged in court, and while US-Iran talks are about to resume. This is not just noise. This is pressure building from multiple sides. Stay with me. We're going to connect Shanghai's leverage shift, U.S. trade policy instability, and the technical structure in silver right now. Let's reset the board. Silver fell more than 2% to below $86 per ounce on Tuesday. That ended a four-day rally. Then it stabilized. It moved back above $88 after briefly dipping below $85 earlier in the session. So in one stretch, we saw below 86, below 85, back above 88. That's not random, that's positioning. That tells you money is moving quickly. It tells you conviction is being tested. Short-term traders took profits. Others stepped back in. That's a market trying to find balance. Now, layer in trade policy. The U.S. Supreme Court struck down President Donald Trump's reciprocal tariffs. That alone is significant because tariffs directly affect global trade flows, input costs, and industrial demand expectations. After that, FedEx filed a lawsuit seeking a full refund related to those emergency tariffs. So this isn't theoretical. There are financial consequences tied to policy shifts. Then on Monday, silver rallied after Trump threatened to lift global tariffs from 10% to 15% in response to the court's ruling. So think about the sequence carefully. Court reversal, market reaction, escalation threat. Trump also warned of steeper duties on countries that play games with trade arrangements. That creates uncertainty. And markets do not like uncertainty. They price it, not always directionally, but through volatility. Now here's another key layer. Despite the threat to raise global tariffs from 10% to 15%, China is still expected to face lower average duties on its metal-intensive exports after the court ruling. So we have mixed signals, escalation rhetoric, but potentially lower effective duties for China. That contradiction matters because silver is both a monetary metal and an industrial metal. Trade policy affects the industrial side. Geopolitical stress affects the monetary side. Now add China. Trading activity increased as mainland Chinese participants returned from the Lunar New Year holiday. That's important. Earlier in January, silver and other commodities surged. Then they corrected sharply, largely driven by speculative flows in China. So we've already seen what Chinese speculative flows can do. They can push fast, and they can reverse fast. Now, at the same time that Chinese traders are returning, the Shanghai Gold Exchange reduces margin ratios and lowers price limits. Timing matters. Returning liquidity, looser leverage rules, wider movement allowances. Let's translate that simply. Lower margin means traders need less capital to control the same position. Lower price limits mean daily moves can stretch further. Less capital required, more movement allowed. That combination increases volatility potential. Not direction, volatility. And volatility, especially near technical inflection points, changes everything. Now let's look at the technical structure. Silver is trading around 88.20 per troy ounce in early European hours. The 14-day RSI is at 54. That's neutral but slightly positive. Momentum is there, but it's not extreme. It's not overbought. It's not overheated. Price is holding above the 9-day EMA. It's also holding above the 50-day EMA. Both moving averages are sloping higher, and the 9-day sits above the 50-day. That's constructive. It means the short-term trend is aligned with the medium-term trend. As long as price stays above the rising 50-day EMA, pullbacks could remain supported within the recovery. The upside reference level is the record high of 121.66, reached on January 29th. That's your major resistance marker. On the downside, initial support sits at the 9-day EMA at 83.03. Below that, the 50-day EMA at 80.15. And if both break, structure weakens and exposes the 2-month low of 64.08 from February 6th. That's your map. Now let's slow this down and do the math clearly. Current price around 88. Distance to the 9-day EMA at 83.03 is roughly $5. Distance to the 50-day EMA at 80.15 is about $8. Distance to the 2-month low at 64.08 is roughly $24. On the upside, distance to 121.66 is more than $33. So silver is sitting between two wide corridors, about $24 of potential downside space if structure breaks, about $33 to the record high if momentum expands. Now think about this in context of margin cuts. If leverage increases while price is hovering near support, breaks can accelerate. If leverage increases while momentum holds, rallies can extend faster. The math doesn't tell you direction, but it tells you expansion risk is rising. And expansion risk is exactly what margin and price limit adjustments influence. Now here's the connection. On one side, you have trade instability. Tariffs struck down. Threats of raising global tariffs from 10% to 15%. China expected to face lower average duties despite escalation rhetoric. On the other side, you have technical structure that remains intact. RSI above 50, short-term EMA above long-term EMA, trend supported. Add in Shanghai cutting margin requirements. Policy margins increases uncertainty. Lower margins increase leverage. Leverage increases price sensitivity. Price sensitivity tests technical levels. These are not separate stories. They are mechanically linked. When leverage increases, moves become sharper. When policy uncertainty increases, reactions become faster. When both happen together, you get compression. And that's where silver is sitting right now. Now layer geopolitics. U.S.-Iran talks resume Thursday. Trump says he prefers a negotiated resolution, but he also warned of serious consequences if a nuclear deal is not secured. So we have trade tension, legal intervention, margin reduction in Shanghai, speculative flows returning from China, geopolitical negotiations. That's a compressed environment, and compressed environments resolve with movement. Quick definitions. RSI at 54 means momentum is modestly positive but not stretched. An EMA gives more weight to recent prices. When the shorter EMA sits above the longer one, short-term strength is leading. Margin ratio is the capital required to hold a futures contract. Lowering it increases leverage potential. Price limits define how far a contract can move in a session. Lowering them widens daily movement allowances. Put together, that can amplify swings. Now the counter case, because discipline matters. Margin cuts increase volatility, but they don't guarantee upside. Speculative flows from China could reverse again, just as we saw after January's surge. If tariffs escalate formally and global trade expectations weaken, industrial demand sentiment could shift. If U.S.-Iran talks de-escalate tensions, geopolitical premium may compress. And technically, if silver breaks below 83.03, momentum shifts. Below 80.15, the medium-term structure weakens. Below that, 64.08 becomes visible again. These are structural risks, not emotional ones. So what do you watch? Watch how silver behaves around 83.03. Does it hold on pullbacks? Watch 80.15. If that breaks and holds below, structure changes. Watch the February 24 settlement after the Shanghai rule adjustments are active. Watch whether the 10% to 15% global tariff threat becomes formal policy. Watch tone and developments coming out of Thursday's U.S.-Iran talks. And watch Chinese participation patterns now that the Lunar New Year holiday is over. Because your own data already showed that China flows drove a surge and a correction in January. Now leverage rules are changing just as participation returns. Huge news today wasn't just the price drop. It was leverage conditions changing inside one of the most important gold and silver exchanges in the world. At the same time, trade policy and geopolitics are in flux. Price is stable for now, structure is intact for now, but volatility inputs are increasing. And when volatility inputs increase, you pay attention. Pull the chart, mark the levels, track the policy changes, watch the exchange implementation. The data is there, connect it, and invest with logic, not narrative.